Today's presentation is accounting in the headlines, using the 2015 film Straight Outta Compton to analyze real music industry transactions through core accounting principles. This film follows NWA as they sign with Ruthless Records and distribute through Priority Records. Their debut album generated over $3.6 million in sales, yet the artists saw very little of it. We will analyze four key figures: a $750,000 artist advance, $6.3 million in album revenue, a 1% royalty rate, and a 20% management fee, recorded across three journal entries. Transaction 1: The artist advance. Priority Records paid $750,000 to Ruthless Records upfront. Under GAAP, this is not an immediate expense. The label debits artist advance receivables, an asset, because it expects to recoup this from future payments. Cash is credited, the accounting equation stays balanced. Assets simply shift from cash to a receivable. The transaction 2: album sales. Under ASC 606, Priority Records recognized $6.3 million in revenue upon delivery to distributors, not when cash was collected. We debit cash and credit music sales revenue. Simultaneously, we accrue $63,000 in royalty payables, 1% of the revenue, as a liability. This separates when the obligation arises from when it is paid, a key principle of accrual accounting. Transaction 3: The management commission. At 20% of $6.3 million, Jerry Harrell's fee totals to $1.26 million. Under the matching principle, this expense is recognized in the same period as the revenue it supported. We debit management fee expense and credit accounts payable. Ice Cube reportedly received only $32,000 personally. That gap between recorded entities and artist earnings is exactly what we examine next. So the film accurately depicts advances as upfront cash flows and reflects documented revenue figures. However, it never shows the recoupment process. Advances are deducted before royalties are paid out. It also blurs the line between accrual bias and what the label reported, and cash bias, what artists actually received. A proper royalty reconciliation: gross revenue less recoupable advances less cost times the royalty rate, would which would have made the economics transparent and likely avoided litigation. This case shows that accounting is not just accurate record keeping, it's a disclosure. Double entity integrity, the matching principle, and accurate accounting all work correctly here. What failed was transparency. Thank you.